Gosh, is this the sell and may go away sell-off correction? Just is that all the market has in it last week? I can tell you this, it's pretty interesting how we've got a lot of different markets to trade and different clues and things that are going on. A lot of markets that are out of sync with their correlations, detachment or decoupling, dollar crude, dollar gold, dollar euro, dollar treasury bonds, things of that nature in that respect, and of course crude oil to even the equity market. So what's the prognosis and what are we looking at and where we go from here? So we're going to take you down a walk of some of my stuff, and many of you have been repeat offenders, and I thank you for that. And now let me go over and uncheck the little smiley face. By the way, we figured this out. When I draw an annotation on the chart, it goes a little bit different color, I think. It just lightens the board up. I don't know why, but anyway, I just thought, as you can see, the clarity's a little bit different when it looks a little hazy. I think it's because of a behind-the-scenes drawing tool. So I just wanted to get that disclosure out of the way. Next, let's get another disclosure out of the way, and that is our risk disclosure that this is educational and information and that trading is risky. So let's go through that real quickly, and everything that we've put out here is, well, needs to be, if you're going to reproduce this, you need to give me a little phone call and consideration. And I think you're going to want to take notes because this is pretty incredible. I think this is the epitome of what trading is all about, today's presentation and where we're going. And I think it's pretty timely because I sent, some of you are on my Twitter account and get my tweets, and I understand there's a couple things that were first and foremost. We did a 3-day seminar in Las Vegas last week. I hadn't been to a money show, and I believe it's been 2 years that I've been absent from giving any seminars or lectures at these financial conferences domestically. We were in Europe and South America, by the way, last year, so we spent some time doing education and spreading some of our message to traders abroad, which how good is that message, I guess, is the next question. By the way, we've got a lot of neat things that we've put out through the years. Mainly, a lot of it's come from the one book called Where It All Started, Candlestick and Pivot Point Trading Triggers. If you don't have that book, I am under contract to come out with a second edition. I've asked for a couple extensions on the due date. It was supposed to come out about a year and a half ago, so they're not too happy with me, but we'll work on that in my free time. But let me share with you, I love this cartoon. I'm taking Peter Pan's taking the little boy to Never Never Land. It's unaffected by events in the real world. And the little boy says, "We're going to Wall Street." Boy, that is just so apropos for the day this environment that we're in right now. Just kind of crazy times. And so when we take a look at the market and it's the sell in May and go away, is it really the sell in May go away? I thought I'd just share this with you. It's more like selling maybe perhaps August, July, August, and go away with the SPX throughout history. Yes, in May, around mid-May, yes, we get a little sell-off historically, and then we kind of bottom out and we chop around and we get a late summer rally. So do you sell in May and go away, and is this year different? And every year can be different to a degree, and yes, this year is different in my books. It's different in the sense that we've had a really strange occurrence between some of the analytic tools that we use, such as breadth and volume. And volume's been very absent in this market as far as volume trends, whether you're using an identifying volume histogram or whether you're using a tool that I helped popularize, back in 2009 when we were doing a lot of presentations, and many of you are familiar with the on-balance volume indicator. But there seems to be a new sheriff in town, and if I may, I'm going to share some stuff with you today that I think you'll find interesting and relevant. So I've got a lot of stuff on my plate here, so let's first foremost talk about the new sheriff in town. I wouldn't say it's a new sheriff in town, but a couple things that we've used in the past. Many of you are familiar with average true range, ATR, and that's a one of my favorites, something I wrote about in that book that I'm supposedly under contract to bring up to date or come out with a second edition. If you've got that book, Candlestick and Pivot Point Trading Triggers, if you don't know which one, it's the one with my face on it. On page 265, I really got into talking about profit objectives, stop losses using the last additional change in a 10-day ATR. So anyway, it is part of watching and formulating what's going on. Looking at total volumes important, and then a volume average. What's the average volume over time? So I want you to focus on this light right here, because this is the ETF that many of you may trade or institutions have been trading, and it's the Spiders. Spiders today alone traded 47 million contracts, slightly below, and on Friday it was about 114 million, so slightly below Friday's option expiration volume, and slightly below the average over the last X period of time. In addition, look at the diamonds, the Dow Jones Industrial Average. Everyone makes a big deal about the Dow or the diamonds. 3,400,000, pretty much nobody's trading it, right? And then we're going to go down to this little product over here called the VXX, volatility. That's right, volatility. And while granted it's not being a profit as much as it was with the S&Ps, you'll notice it has exceeded volume today over the S&Ps. So if you ever had the suspicious feeling that traders are possibly giving up spider put options for volatility as far as hedges, this may go into that realm of concept, and yet we'll talk about that in just a few minutes, okay? Because that's kind of important. So before I really get into everything I want to talk about today, can everyone hear me? Number one, do we have sound? That would be important. So some people have sound. One person doesn't see the picture. Do we have the picture? Is there, if you could just give me a Y for sound and a double Y for picture, then we can move on. And if the majority of people have picture and sound, then you need to probably log out and log back in. And I don't know why that is that you would not have the picture. But needless as it says, if this year is different, and let's face it, it's different because the landscape of what we trade, how we trade, and where we trade is a heck of a lot different than when I first put out this book, Candlestick and Pivot Point Triggers, back in 2006, or 5, excuse me. That was quite a long time ago, in essence, 12 years. I always called that book to be a timeless book. I said it will stand the test of time when I wrote it, and it's still true to this day. The techniques that are in that book are being actually coded for trading systems and algorithm signals and indicators, and many of you have had a chance to follow through some of those. Now it's a matter of what are we going to do, and are those tools and techniques going to help us to uncover the direction of the market and trading opportunities? What are those opportunities? Are they opportunities for massive downside correction in the market, or do we see maybe some more of the same, a grind slowly higher? And I think for right now, some of the other analytics that I use, and I'll share this with you real quick. This is the top stock indices that you see trading here, the spiders, the Qs, the diamonds, which, not a whole lot of volume, but no one's really trading them, right? NYSE, the New York Stock Exchange Composite Index, NASDAQ Composite, and the Russell. So the Russell's the redheaded stepchild of the bunch as far in terms of volume and breadth is concerned. It's been in a tight range. We thought we had a nice little breakout over here over a month ago. We got long, and we quickly got out a short-term trade. We saw the market come right up to our pivot resistance. Volume started to melt down, and breadth. This is the advanced decline comparative ratio line. This gives us an idea of how many stocks are moving up in concert with the index. So the advanced decline indicator, we started to see a move, but it wasn't sustainable, and that was part of the issue. So here's an interesting story of the current market environment. While we were in Las Vegas, what we noted was that the market itself, especially if you see this little pink head perking its head up, and you look at this yellow line perking its head up, well, this is the NASDAQ 100, the Qs. And the Qs still have a strong breadth reading. So it's not like we could blame Amazon, Amgen, certainly you can't blame Amgen, but you can't blame the FANG stocks for bringing the Qs higher. It is, as you can see clearly, or maybe as you'll see a little bit clearer, and I'll bring this into focus, the advanced decline analysis has been grinding it out, giving a couple false sell signals, and then bang, straight back to the upside. So what we were looking at least in the NASDAQ, is that while it does appear that the market's getting tired because it took about 5, 15, 10, and whatever that number was right in there, it took 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11, 12, 13 or 14 days to go up. It took 1 day to go down. And then the market's recovered. But what has happened, folks, is that the breadth of the market and on strong volume has made new highs. That, my friends, is not that bearish right now. Now, it's positive, and that's why I wrote a positive on volume, and it's positive on breadth. The relative performance is in the NASDAQ 100 versus the small cap growth is off the charts. Small cap growth stocks are up like what, less than 3%, and the Qs are up about 17%. So there's a 14% difference in valuation or net change from the beginning of the year. So what is my take on that, and what is the tea leaves or the technical indicators revealing? Well, quite frankly, if we want to get ultimately bearish, and we were looking for a little correction, we got one last week, thought possibly Lam Research and some of the other stocks would see a pullback. They did, but we quickly got out because things weren't right. It was not even a sharp decline on any type of concernable volume. And what do I mean by that? The moving average component of the on-balance volume, we did not break it. We couldn't even break it. So with that said, we really aren't in a period right now where the market is ready to roll over and die. So that's, I guess, the best point that I'd like to point out to you guys. The breadth of the market, we've made new highs. This is a volume indicator that is showing that we could most likely break out and maybe take an upside swing. Over the last 2 days, we've been more often taking little day trades to the upside today, and it's been very painful of an intraday move in the equity market because we are approaching that 240 or 2400 magic milestone in the marketplace. So what do we kind of see from a seasonal perspective in the market, and how does that relate to undertone analysis? All right, well, that's where we're going to go and take a kind of dissect the difference between the seasonal tendencies of the S&Ps, which typically we go down, and then in June we see a little bit of a rally. So what could lift the market up in June? Well, home builder stocks possibly, perhaps maybe a little bit of energy could get into the party, or perhaps maybe we could get something that's been lagging, and that would be in the drug sector, and that's been under big fire. Drugs and biopharma or biotech pharmaceutical sector stocks have been under fire since prior to the election by both the President-elect Donald Trump as well as the Democrat running contender Hillary Clinton in their famous texts, emails, tweets, you name it, about drug costs being too expensive. And it all started with this one company called Mylan, the EpiPen. And that, by the way, was the whole thing that, you know, kind of really shook the investor tree, so to speak, of people holding weak longs and reassessing whether or not they wanted exposure to that space. So what has been the leader of the market in the NASDAQ? It's been application software. Obviously, there's other sectors that are leading the way, defensive stocks, you hear about Boeing, etc. But there's others like industrials and some very select materials. And this is a tricky market because, let me tell you folks, the institutions are able to move vast amounts of money at a single flick of a switch, and they're not even flicking switches anymore. It's all algorithmically generated at this point in time. And you're seeing, and when we were in Las Vegas giving this presentation, this 3-day seminar, we were talking about algorithmic trading, and we were talking about the increase in institutions using volatility products. I think that if you go back, if you have the Wall Street Journal from this weekend, in the business section, it was a small article. It's in the last page of the business section of the weekend edition, and it talked about like a guy who's like the head of Putnam Investments, talking about all these hedge funds and institutional traders that are using volatility products. And so it didn't say what they were using or how they were using it, but when you look at the VXX that I just shared with you, making a higher volume trade today than the spiders, I think we all have an idea of what volatility product the institutions are trading now, correct? VXX, there's an enormous amount of volume in trading in that product. So bring it on home, John. Here it is. The NASDAQ 100, application software products, semiconductors. That's what's really been driving home. And of course, it doesn't hurt to see Amazon trade higher and watch Apple still trade north of 150. So with that said, what does the NASDAQ 100 component typically do in June when the S&P's kind of, it almost has a reversal of fortune in the month of June going into July, and then earnings season, we might see a little spike, and then sayonara. So this 17% year-to-date gain in the Qs in the NASDAQ 100 may be coming to an end from a seasonal perspective. So that's one of the things that I would have to warn, that it's kind of like a very strong seasonal resistance target area. So in the next week, you and I think this would be a good time to start exploring some of the stocks that have had stellar gains and testifiable evidence, such as a seasonal trend analysis. We'll start nailing down intraday and end-of-the-day scans, and many of you who are Thinkorswim users do have access to the PPS indicator. And that's the first thing I would suggest people do, is to run scans, not just in the NASDAQ 100, but also in maybe software applications. Adobe, for example, is one. And also in the semiconductors like Lam Research, Micron, Microchip, Intel, et cetera, because those have a strong component weighting to the NASDAQ 100. So with that said, if we are going to say what's going to change, we do have a little dynamics between this tug of war of tide sea of change in valuation of what kind of transpires and can affect these indexes. I mean, an individual stock can outperform its stock sector. In other words, you might see a semiconductor stock. Let's take NVIDIA. It might not go up, but the rest of its competitors might go down. So not all stocks will adhere to its sector seasonality, but combined, multiple sectors that lose their seasonal strength and may be subjected to some pullbacks, that's where the NASDAQ 100, at least in the first week of June, give or take a week, because that's what this represents, the first week of June. And that is in about a week and a half or so. So give or take the scale of a week early or a week late, we'll be paying attention for maybe the NASDAQ to underperform relative to the S&P 500. Now today, in terms of net change and percentage change, that started to already happen just on today's trade basis. So how do I know that? So if we take a look at the performance today and the net change, so we'll take a comparison of apple to apple. Market ETF, the Qs, down, spiders up. So relative, that spread correlation is starting to unwind a little bit, right? So is that bearish to the market, or are we going to start to see maybe like today where the Russell started to come back up just a tad? I think that's the combination that you want to start to see. Rather than get ultimately bearish the market, we might see still an upside move in equities going into the summer, or at least in the next few weeks, and it might not die. It's just not going to roll over and crash. And that's what the advanced decline kind of suggest with the volume. It suggests that the market may stall a bit in the Qs. So that's kind of what I would be looking at. Now here's the Russell, the small cap Russell 2000. Is this the time of year that we could really look for an outperformance in the market? Well, from about late May, right? This is the month of May, where we are right now, going into about the middle of what? June, for the next 2 weeks. Voila. Guess what happens to the Russell? It kind of has a little short-term bounce. Maybe this is as we end and come into June, which is the last month of the second quarter. We also have a Federal Open Market Committee meeting happening in June. Many of you are already aware of that. So in fact, the FOMC is June 13th and 14th, which is about and I can't draw it, mid-month on the Russell. So preparing ahead, if you're an index trader, if you're an option trader, these types of analytics are going to kind of give you an idea so you're not perplexed as to maybe why the Qs aren't moving as much and the S&Ps are outperforming. So that's kind of the first thing I wanted to go for as far as, do we sell in May and go away? And I think not. I think there's going to be a lot of trading opportunities going forward. Mainly, there's some dynamic structure going on with some of the energy component stocks. So energy has lagged this market all year, and everyone knows that. I don't think that's a secret. Let's take a look at the energy XLE, and we'll take a quick look. When I say it's lagged, friends, it's relative strength on XLE versus the S&P 500, and I want to share with you the person market catcher. Many of you, we introduced you to this in a webinar we hosted a while back. This indicator reveals the relative strength versus the S&P, and it gives it to us in several phases. Since it generated a sell signal on that's a XLE, that arrow that you see is a PPS sell signal. This is the TradeStation platform, and the relative strength and volume analysis has not been positive. So now the XLE, it's gone down, 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 and here's the interesting component part. It's starting to get less negative, number one, and they're starting to see some accumulation in volume in the ETF itself. So that is a weekly chart. The XLE would have more influence on rising both the S&Ps and lifting maybe temporarily support in the small cap sector ETF, the Russell 2000. So we're going to be on the prowl for further upside buy signals in XLE. Let's change this up to a daily perspective. Now, from a daily perspective, we have a technical indicator situation developing, which is a potential. We have lower lows here, and the relative strength is showing a little bit of bullish convergence, and as you can see, we've gone from red to fuchsia. And this is starting to reflect that it is in the energy component sector starting to improve. It went from weakening to it's now improving. And the volume, as the price has gone down, the volume indicator is going up. So energy is the one sector that surprisingly could see some further upside. It's going to take a little while. We need to get a couple things jumping here. We need to get a last conditional change, a breakout above the pivot, which is that blue. And I think if you get that, you're going to get a whale of a pop that comes into the XLE. So relative to XLE, we can break this down. Which sector looks a little bit better? Oil and gas exploration or the oil service sector? To be honest with you, it's 10 to 1 or the other, but I think the XOP looks a little bit better. If you put a gun to my head, odds favor XOP sector is the one, to me, that looks slightly less bearish. Let's put it to you that way. So, and again, it is 10 to 1 to the other. We're going to need to see a pop, at least in this ETF, XOP. And when I say a pop, I mean a daily close. We're going to have to see a daily close over this line in the sand at 3608. So if you write that down and say, you know what, I'm going to set an alarm and watch what happens if the XOP gets a daily close better than 38.08. And if we do, it's not a guarantee that you're going to make guaranteed money, but it improves the odds that the momentum is going to shift to the upside. Think of what's been going on since 3,800. 38 even, back in April, we had one single candle, that red candle, and the market is yet to be able to close above it. It's traded near it, but it can't close above it. If it closes above that line in the sand, we stand a strong potential to see upside. What sector or what stocks would look best in that sector? Several names come to mind, and CXO, Concho Resource, which is one that we have a position in, it has a little bit better performance right now than some of the other names in this space, only mainly because it has a little bit of a higher high, higher low kind of trend. The relative strength's improving a bit, but it's got to get some giddy up and jam going pretty soon. CDS or CDX, excuse me, and just to get through some other names for you. Now, in some of these names, this looks like dog meat, and Exxon looks like not that bad, but boy, I'll tell you what, anyone that looks at a chart could clearly see that it really has had a hard time getting above a resistance level that's lasted forever. Relative strength is improving, and it is fired off of relative strength performance that's getting better, but it's not great. There's no volume. I need to see this thing get a breakout above this 83.36 handle before I say Exxon's got a shot at further gains. So there are some other names in there which will be divulging to our community, but I would say start looking at some of these names, and as you can see, there's one common denominator in the energy space. They haven't fallen, they just haven't risen, and they've been in a sideways trading range. So the longer the time period they've been in a range, the bigger the potential for the breakout. And so that's what we want to be on guard for. I think the time period of selling iron condors has left us. We're getting ready for a move one way or another. And when we do get a breakout of these types of ranges that we've been in the energy space, it will be a dynamic move. And if it is to the upside, it's going to weigh on positive. Well, the beta effect will be very positive for the S&P 500 and the small cap relative to the NASDAQ 100. So therefore, we've got that type of analysis going, and that's a very simple phase of what we could call, I guess you could look at that as correlation trading and looking at the percent change, net changes. These are analytics that if you ever have been reading about, and I guess in the newspaper from over the weekend about volatility trading to yesterday about quantitative trading, quants and algorithms. Folks, we've been using TradeStation for over 20 years, and it's exactly what everyone's been using, so I don't know what the big, rush to secrecy is. But it's like a brand new discovery, it seems. Well, we've been looking at a lot of algorithmic trading. It's just that these guys are taking it to a whole nother degree. At the end of the day, think of this for a second. We all have equal access to the open, the high, the low, the close, volume over time. But now we're taking a look at what the percent changes of one product to another relative to something else. And so looking at in terms of percent change, in terms of volume changes, these are kind of some other weighted ways of measuring market trades, and that algorithm type of criteria is what's really helping to make more trade decisions. So in the world of the market, we still have to eat at the end of the day, drive somewhere, whether it's with putting gasoline in the car or plugging it in with a Tesla. And transports has always been a part of the economic engine, so to speak. Right now, I don't want to give an economic class 101, but we all have an idea that without consumer spending, GDP contracts. GDP is sub 2%, so consumers doesn't look like they're spending a whole lot. They're all convinced and feel confident in the market, in the environment, in the economy, but people are still not spending, as evident by looking at some of the consumer discretionary sector stocks. What about transports? And I'm talking airlines, rails, I'm talking shipping, I'm talking the ground transportation, UPS, for example. What does transports do this time of year? Well, typically they have a big rally, and they haven't, and then they kind of cave down a little bit. So the transport not a big help. And if you start to say, well, the transports are going down, they're not joining this party, here's one of the things that's kind of funny. They generally don't see strength this time of year. So we're not going to look for leadership coming out of the transports, or probably if anyone in institutions are looking for seasonality, we probably won't get a pop until the end of the first quarter, or excuse me, the end of the second quarter, which is at the end of June, by the way. So what does that mean? It means if energy goes up, transports or go down, don't be surprised by that analytics or that relationship if it occurs over the next few weeks. That's the message. We're looking for energy sector to maybe pop, and we're looking for maybe drug stocks to maybe come out of and give you lift off here. All right? That's kind of, I guess, the little message. Now, we've got most traders have little issues and problems, and there's solutions for every trader, I think. And one of the solutions out there that we like to look at is you got to have better market analytical skills. This comes from a slide that we were giving at our 3-day seminar. You got to understand, I think, to be a better trader, and many of you do, understand derivative markets like options and applying more option strategies. But also, I think this has kind of changed this year in the sense that I just shared with you that difference between the volume in the SPY and the VXX. Many of you probably don't even know what the VXX is. It's a volatility ETN, and it trades off of the contango between the VIX, VIX. So the VIX is the fear factor that you hear about. When equities crash, the VIX goes up in value. Well, the VXX is like a new sophisticated way that institutions are hedging against their portfolio. So I don't think a lot of people are trading in the VIX as far as the retail is concerned. One of the things that I did in Las Vegas was, once again, I just subtly opened my mouth about it, and all of a sudden people were like, wow, they had no idea. And that, I guess, is a new thing. A good thing about going to a conference is to learn new ideas. I was very shocked to see all of these traders out there who have been trading options, they've been employed in the market, and weren't familiar with the fact of a simple analytic of how much volume is really going on in the VXX strategy. So I think we need to have better market analytical skills and better observation. Obviously, risk management, position sizing is very important in your trading. I mean, there's an old adage in the market: whenever you're right, you're always in 1. Whenever you're wrong, you're always in 100. Nowadays, it's like whenever you're right, you're in 10. Whenever you're wrong, you're in 6,000 shares. And I think one of the best solutions that people can have is to try to engage and gain an ability to anticipate market opportunities. And I just went through seasonality with you to maybe give you a futuristic guide in the next 30 days or so, what might transpire. And if it does, if you see transports down or weak but energy up, it won't be a surprise to you. And if you see the S&P and the small cap maybe lift and the NASDAQ not go down, and it might be like a perplexing scenario for you, perhaps anticipating that market opportunity by attending today's presentation may help you. Most importantly, understand and use algorithms. Understand and use algorithms. What is algorithms? Well, simply put, the high closed doji system that we put out there almost 2 decades ago, that's an algorithm. If X crosses Y, if the close is greater, by the way, this is an important algorithm. If the close is greater than, not equal to, but it's got to be greater than a prior bar's high, then go long. Okay? It's got to be greater than, not equal to. Equal to, not greater than. Greater than is greater than. That's an algorithm. And by the way, seeing a lot of that going on in the market. Also, solutions for problems for traders face is they need to be a little diversified, and I think in this environment, market correlations is very important. We just went through together a real quick summary of market correlation, such as outperformance of the spiders and the IWM to the Qs. And everyone says, well, the stock market went up or the stock market went down. but no one said by the same amount. Case in point, NASDAQ's up 17% year to date, and the IWM's up 3%, more or less. Don't quote me on that. It's around that, right? It might be 16.2, whatever it is, from a year-to-date perspective. This is live, and I don't have my exact facts in front of me, but you get the point. The Russell is not much more than 3%, 4% up on the year, and the Qs are up almost 17% year to date. That's a big difference in diversification and correlations. There are other correlations, and here's what I want to reflect, because I know there's a lot of day traders out there, and some of you guys are real interested in that correlation when stocks go up, bonds go down on a given day, and that correlation between bonds and gold. And so I think trading systems, and there's a lot of them out there, guys. There's a lot of different trading systems, and there's 10 different ways to skin a cat, they say. You have long stock, short calls against your long stock, but no one ever said you had to do it 1-to-1, so you could do it ratio, and you can help time that system. In other words, buy a high dividend yielding stock, only sell calls against half the position in case the stock rallies, you don't get called out of your trade, and that way you still catch a dividend, right? And then you can time it by not even selling options against possibly earnings risk. So you can time it around the other 8 months of the year rather than the timing of an earnings event, a binary event. There's trading systems on breakout and momentum, which is what we use. There's different filters, time of day and week. Don't trade Sunday night, or maybe start trading at 3 in the morning when the big moves occur. We get more moves at 3 in the morning. In fact, today we had a cleaner move, again, just case in point, in the S&Ps at 3 in the morning. Many of you might not be aware of that. We went from 91 to 97, a 6-handle rally in the European session relative to the chop and the slop that we had to deal with in the U.S. market. And if you've been noticing that over and over again, where the market doesn't really do much for us, but it does move for in the European session, it's not because of the Europeans, it's because of the hedge funds. And when one day you're watching S&Ps and then gold moves and bonds move and euro moves and crude moves, and you're not looking at any of those. I think that's where you got to look at correlations, and I'm going to share that with you today a little bit about what to prepare for in the next month ahead. I already kind of went through relative strength, and then we just covered a little bit of seasonality that's going to affect you, at least in the marketplace. So this is kind of like an important little presentation to get you maybe prepared for what's ahead. Now, the relative strength approach, it adds general value to the investment process. This little indicator that we put out for our TradeStation users, it allowed us to visualize and grade the relative strength. It was color-coded in order to give us pretty much immediate, identify immediately the performance of the market. I mean, if you're in, for example, this was a little trade for Whole Foods. Many of you will recognize the high closed doji, the little PPS buy signal. We could see the volume was showing bullish convergence, and the relative strength was going from red to fuchsia to blue, and it went right off the charts in Whole Foods. So Whole Foods was starting to see that, just like I've shared with you, now it's not 100%, but this setup where we get that market that makes a lower low, the secondary low versus the primary low, and we get a volume convergence and then a relative strength improvement. And that's something that we're starting to see in some of these energy names, by the way. So that pattern right there is representative of what we're starting to see and what I think you want to look for in your trading going forward, okay? So, by the way, if the seasonality that we just went over, because I didn't make that, year in and year out, that's the average trend that prices make. We want to look to see if the technical picture matches up with the seasonality. That'll help us to identify the trading opportunities ahead. You may not have bought Whole Foods, but you sure as heck shouldn't have been shorting it. And I think in our community, we caught a little bit of that trade right there. So that was kind of nice. The person's market catcher, it helps us, at least from a relative strength identification, identify weakening to a leading stage. And we have that in a histogram, as I shared with you. and it gives us a zero line crossover. There's a few things that are there, and we get these little bars, and I'm just going to share with you what relative strength has to do with the market. If a stock is starting to outperform relative to the S&Ps, it's going to start to show in terms of percentage positive gains, okay? If it starts to lose its relative strength as it starts to move higher, what happens is it starts to show us a bearish divergence. And institutions right now, this is the big buzz indicator, relative strength. You might hear people talk about, oh, the market relative to this stock relative to the S&Ps, it's weakening. Well, weakening is not good. Everyone's chasing alpha, money. Everyone wants money. And what they might do is, even though they might like the stock, what they will do is maybe liquidate, and until things turn back more positive, they will trade. You know, the funny thing is, institutions are trading, and you know who else is trading? Warren Buffett. Warren Buffett bought IBM and sold IBM, and he let the world know as a favor that he sold it at around 180 when it was trading at around $1.50. Real nice. Thanks, Warren. You helped out your fellow mankind. He's a trader now. He's no longer a buy and hold investor. Warren's been trading. So when everyone thinks he's an investor, he's really trading. And I'll bet you, and I can share with you because we did this at our event. Let's take a look at IBM. Where do you think Warren was probably selling the market, by the way? As soon as you could see this the volume was going down, the relative strength went negative when the market was making the highs. Now, Warren came out on CNBC interview and said he was selling it when it was up near 180. I think when the market was trading here, he was distributing the stock in that time frame. Notice what was happening. IBM went from bright blue and outperforming to all of a sudden 1 minute, it went negative. The world turned it off. Well, the world didn't turn IBM off. Warren Buffett turned IBM off. So he was long from a year earlier and had positions earlier, and he sold a 30% stake supposedly up near the 180 level. And the roadmap of these indicators are showing that. Now, we don't know who's selling. We just know something was wrong with this stock at 180 because the volume was coming out and the relative strength got crushed compared to the market. So when we get a stock or a sector that is moving up, but there's no volume in it, and relative to the S&Ps, it's losing its relative strength, el no goodo, muy mad, it's muy mal, muy bad, it's not good. Now, inversely, if we have a stock that's going down, but the relative strength is improving, like over here, right? The relative strength, the market's making a newer low, the volume's going up, and the relative strength improves, then that's good. And that's kind of what we're looking for as far as the footprints in the sand, so to speak, to identify trading opportunities in this market. Since this is an algorithm move in the market, and I think we can see an algorithmic move means people are probably trading institutions like Facebook. This is an amazing picture because Facebook, after the election, and this goes back earlier this year in December, I mean, it just kept going up. And I mean, I'm looking for a sell signal. I'm waiting for a sell signal. And, sure enough, it never generated a sell signal yet. But we'll be watching for Facebook because Facebook is generating lately a bearish divergence pattern. And just so that you know, I'm not making that up, let's take a quick look. It's forming a bearish divergence pattern in the sense that as it rallied up in here, its volume is off, and relative to its highs in February, it is sharply higher, and the relative strength is lower. When this thing fires off negative and we get more volume decrease, I would imagine Facebook has got some issues. So, I mean, these are indicators that we want to use on our side, and this is what some of the institutions obviously have in their arsenal of weapons. What makes that tool kind of cool is that we get at least numerically on the radar screen what's going on, all right? So when we move forward into the next month, we want to make sure that if we're buying any stock and it's in a strong sector, supposedly in a seasonally strong period of time, we're going to double check to make sure that the relative strength versus the overall market is improving. In other words, this indicator is firing off bright blue. So when it fires off a bright blue and we're in a PPS buy mode, baby, time to get long and jump on the bandwagon. That's what we're looking for in that market. So now, what I wanted to point out to you guys as far as correlations, and we covered this at the seminar in Las Vegas, and I want to introduce this to you guys. A few people had asked me at the seminar, my indicators and my system. I just want to point out something to you. On a given day, we've got the E-mini S&Ps, the euro currency, the U.S. bond market, crude oil, and gold. Now, on a given day, we might see a move up and no correlation between bonds going down or maybe crude oil and maybe gold. So there are algorithms in here that generate buy and sell signals independent of each market. Now, I know if you're not a day trader, this is not important. If you're a stock trader only, this is more of just proof of showing you where we have gone into algorithmic trading and what we are doing as an entity here at Person's Planet, okay? So we've always taught about algorithmic setups, like I just mentioned, the high close doji, a PPS indicator. That is that arrow that points up. That's the arrow that points down on your screen. That's created by a series of things that have to happen. Those things are considered algorithms, okay? So algorithmic trading has been going on for quite some time. Now, in today's type of trading, and this is actually a screenshot from today, by the way, and in today's trading, I mean, you look at a market and you say, well, you got a sell signal in the euro currency and you got a buy signal and a sell signal, and that's on a 5-minute basis. And gold, you know, some of you might not want to trade these little sell signals and buy signals and looking at bonds where it gets short and possibly, I mean, most likely in a trading room, which I have, I can't yell these trades out fast enough. So we need to have something that's a little bit more pronounced. When you look at different sells and buys, we also have to kind of filter them out because we can't take them all the time. This is the euro currency, and I just wanted to share with you, you know, not all signals make money. So this is a great example of what traders need. Traders need a little education as to, you got to understand, not everything's going to go your way, and when it doesn't, you got to get out. This was a position which went short at, again, 3 o'clock in the morning, but it's the euro currency. And then it went short again. How many of you have gotten short a market, gotten stopped out, and were afraid to jump back into the same trade twice, right? I think a lot of folks, but just to demonstrate, you take one hickey on the market here, and then it goes down. One of the things that's interesting is the profit target. So you got several things at issue for trading in this market that's run by algorithms. Number one, you might miss one. You might miss the one winning trade. Number two, you might not get out when you're supposed to. Number three, you just might not be able to trade that for whatever reason. As we went through the rest of the day, here was a trade we went that did get stopped out. The system faster, and I could say it actually went long, and then it went short again, which is a trade we did take, and it made up for the little hickey on the first time around. But needless to say, these are all trades and indicators that are based and predicated on everything that we've put out in our lifetime. This is a very powerful indicator system strategy that is now automated for us. It does a couple things. When you get a signal that goes long or a signal that goes short, you'll notice that it sells 4 and then it takes half off and then it trails the rest, right? System sells 4, gets out of half, and then it trails the rest. Then you get a system that goes long the market, it gets out and then trails the rest. And then it went short, it gets out of half the position, and then it stops out flat the rest. I don't have the perfect system that says I'm going to buy and sell every single high and low. That doesn't exist. And I don't have the one that says, well, how did I know which signal was going to generate the most profit? I don't know that either. So I'm here to tell you one of the best strategies that I've had that I've been teaching for over 20 some odd years is get out of half your position and let the winners ride and get stopped out. So I just wanted to share with you guys a method of trading as we get into this next month. There's going to be a lot of trading opportunities because the algos and the quants aren't going away. And you're going to have to learn this. Now, that's kind of an important thing to have looked at. This is a system, and I just wanted to point this one out to you. This is the VXX, and this is a system, and I told the room today, by the way, guys, it went short at 1465, and it covered the position. So just letting everyone know it had covered the position. Now, this is a system that is designed for equity traders and system traders that is able to take some pretty good size in the marketplace. All right. Now, let me point something out about that VXX real quick. This is the VXX system. It takes some sell signals, right? It went short here. It lost some money. Didn't win on that trade. Then it went short again. Then it went short right here, and it lost a little money. Then it went short, and it lost a little money. Then it went short, and it lost a little money. Then it went short, and it lost a little money. Then it went short, and it made money. And then it went short, and it made money. What do you notice here? You get stopped out, and you do take losses, but guess what? It makes more than it loses. Let me share this with you, and I'll just wrap this all up for you. Take a look here. That's the equity line curve on this product going back since, well, let's do another little thing for you. We're going to format the symbol real quick, and let's go back, what do you say we go back 8 years? 8 years. Let's look at 8 years. Let's look at a back test study of 8 years of this product. So it started in May of 2009. That's a pretty stellar performance. This is a pretty stellar 2.5 to 1 profit factor. This is a 54%, let's call it, accuracy. Number of profitable trades is only 54%. So that means just slightly north, 47% of the trades you take lose money. I'm here to tell you, folks, you got to get used to kind of losing, but you got to be able to know when to get back into the trade. Now, here's what I wanted to wrap it up with. I know a lot of you folks, especially at our seminar, are interested in indicators and our work. Now, I've always been a system trader. I've always back-tested stuff. You read any one of my books, and every single one of my books, from Forex Conquered to Candlestick and Pivot Point Trading Triggers, had back-tested information. In fact, I was the first guy to actually do a back-test study and why we figured out dojis and hammers were important. And that was in the book Candlesticks and Pivot Point Trading Triggers. But if you're day trading in the market, or if you're an ETN, ETF trader, we were not going to do this, but it's something we were asked to do by several people at the Las Vegas seminar that said to me, John, I'd like that. What's it going to take? And so I am more than likely, and we are right now in the process of making a system designed for individual traders. And what's cool is this is a trading indicator with dynamic results, but we got to have trained individuals. This is not like, here, buy it, go away. You're going to have to get trained. As of right now, I have two different things: the E-mini S&P crude oil futures and the VXX product. Now, this is only going to be available for TradeStation users. It will be an add-on for JP Indicators lifetime subscribers, because I know you've been trained. It's going to be a quarterly lease, and it's going to be absolutely for a limited amount of users. And it's for those who trade futures, ETF, ETN. Now, if the lease version, it will allow you to auto trade or use it as an indicator. It will give entry, stop, and a first profit target by painting lines on the chart. So for example, if you're trading in the market and it gives you a long position, which, by the way, remember today we had that profit target on the ES for some of you that were in the trading room today. That was pretty amazing stuff. It gave the trade, why it got in. This is today, by the way. This is the loss, and this was the profit target. So it'll give you the reason why you're getting in. It'll tell you where your risk is, and it'll give you your profit target. So that's kind of when I say it paints a picture on the chart. This is the version for the futures. That's E-mini, crude oil, gold, euro currency that we are looking to help people use. And when I said limited amount, the futures is limited. We're going to only have limited licenses because of the fact we can't have everyone getting into the same market at the same time on the same signal. Can't be done. The price is going to be $500 a quarter for those who are interested in this. So at this point in time, this is some pretty powerful information, powerful in the sense of how it can work for you. And if you're interested, we're also putting out the VXX product. But what you're going to need to do if you're interested, and we're going to filter out who can get it, because we cannot have people that just turn it on and just forget about it. You need training. I mean that. This is a powerful system. We're making it available for our lifetime PUG users. If you're interested in this, contact us here at personsplanet.com. Go to our website, contact information, or go just send an email. You can send an email to mperson, M-P-E-R-S-O-N. I just threw my wife, Mary, under the bus. mperson at personsplanet.com. If you have an interest in this, you need to contact us. And when I mean limited licenses, it's limited. The VXX, that product right there, that's for more equity traders and traders that want to trade the ETF and ETN. And it's a system solely designed for the VIX. If you're interested in just that product, you need to let us know. If you're interested in futures for day trading as an indicator and firing off on all cylinders, you let us know. Give us a call at 561-655-1881. You will not see this advertised on TV. I guarantee that. You will not see this being displayed in heavy marketing. I guarantee that. Many of you have seen me in presentations before, and I really sincerely mean this. This is not something that's going to be heavily marketed. I think we've got a really neat thing that I'm not going to say it's the Holy Grail, but it's damn close to a dynamic system that's working over time. And when I say over time, a lot of the strategies that we put forth that's in here, we've written about in several books. We've just encoded, we've quantified, and we've enhanced. So with that said, I feel that this is the time frame for quantitative trading. Everyone, it's the buzz. It's not just the buzz, but it's the fact that we all sit down and possibly may miss a trade setup, and we wanted to be in it. We got busy with the phone call. We got busy with something else. We missed the trade. We were in something else. Guys, this is that solution. And I think for automated trading, for short-term in nature, and at least for a different way of trading, the wave of the future, and this is not a wave of the future with the VIX products. They've been around for a while, as you've just noticed. But for algorithm and quant trading, this is the place to be. And if you're interested, give us a ring. I hope you found today's information, at least from seasonal perspective, of what to expect in the market going forward, and as well some of the indicators that are behind the scenes that are helping us to quantify that seasonality. Always remember this in summary, folks. Seasonality is not the end all. Technical supersede seasonality. If the stars don't line up, don't do the chart. Don't do the trade, I mean. With that said, I hope you enjoyed today's presentation. And if you are interested, you need to contact us immediately. We are taking requests and we are taking deposits for a first-come, first-served licensing agreement on the Jab Quant service, which is the futures, as well as the Algo VIX product for ETN ETFs. Thanks, everybody. I'll see you later. Until we meet next time, have a great week and happy Memorial Day. And may I say, and finally, thoughts and prayers to everybody, Manchester, England, for the loss of the children that we're seeing, a simple rock pop star, Ariana Grande. It is just a heinous crime, and we definitely reach out to those people. As an avid music fan, I couldn't think of a more atrocious act. Everyone, thank